Hey everyone, hope you're doing well. So this will just be the longer video kind of on, I suppose, at the start of when you're trying to, invest, save, or whatever it is you're trying to do, save for a house, what have you, is having a high level of interest the most important thing you can do? And realistically, no, it's probably not going to be the most important thing. And I'll go into that shortly. So yeah, basically, even if you've got £10,000, dollar, rupee, whatever it is in the bank, if you've got 5% interest, great, you'll get £500, dollar, rupees, or what have you. But that takes an entire year. So divide that by 12. So even if you, and then it's just not a massive amount of money, is it? So and then if if you're only getting 4.5% instead of 5%, you're knocking a few pounds, few dollars, few rupees off per month. Again, it's not life-changing money, and realistically, it's not gonna change your life at all, because unless you do something very clever with it potentially. But for most people, it maybe won't make much difference, and that's because by the end of that same year, prices, as we probably have all experienced, have kind of maybe gone up by that, if not more. And there's a bit of a phenomenon where if you're buying cheaper, or what used to be cheaper products, the rate of increase on those is higher. So if you used to buy can of beans for 50p and now they're 65p, the rate of increase on that's quite high. Whereas if you used to buy a £2 can of beans and now they're £2.50, then it's not as big an increase. And that's even though the increase also in monetary terms is higher, but the actual percentage increase is less. So that's a bit of a, I suppose, a phenomenon with that. So and that's kind of why apparently with budget airlines, obviously their margins have been squeezed more than the, I suppose, historically higher priced airlines, is because there's kind of less wiggle room on the cheap side of anything, cheap products, cheap services, what have you. So yeah, but we'll keep going. Right, so yeah, so as you can get high interest, and that's good, and it's not a bad thing, but potentially most banks aren't going to give you above inflation levels of interest anyway. So if base rate is 5%, generally providers are going to give you 4.85%, or if you're lucky, they might put it right on 5%, but they're probably not going to give you over 5%. That's pretty rare. There are some occurrences for it, which I'll put some links above for the videos, but it's again fractions of percentages. So unless you've got really, really, really huge amounts of money, it's not going to bring much income in. And if you're thinking kind of generally on rate of return, no one's going to get particularly rich off 0.1% interest on a normal amount of money anyway. So or even a large amount of money is not going to make you very much. But what you can do is, obviously, once you've, I suppose, put the foundations in place and you're kind of, I suppose, in the habit of saving, which I suppose is when people get houses, they effectively, I suppose, are forced to save into the equity of the house effectively. And also you've got the counteracting effects of, I suppose, costs to the house, and you've got counteracting effects of the interest. So if you pay off interest, you don't gain any equity in the house per se, but I suppose later on you'll have less and less interest. But it's a good habit. So most people take out a mortgage for 25, 30 years, whatever it is, so you're effectively forced to save into, instead of forcing yourself to save into a bank where at the moment, yes, you might get 5% interest and inflation might be 5%, so you're not losing value, but not gaining value. Also with houses, they do generally gain value, which is, I suppose, a plus. But then you've also got to think of, they do sometimes have costs, either initially, ongoing, later on, they're going to have costs. And then obviously, especially affected by the interest rate is also your payments back. So if you're paying loads and loads of interest, it's not really saving. It's only really when you start to pay off the actual balance of the actual house, as in the sum borrowed, I suppose. So obviously it's like a forced way of saving, which is it's good for the habit. But also you could, I suppose, if you're disciplined enough, you could do that just in cash. and as long as you're getting a reasonable rate, you're not going to lose value. But that only gets you, I suppose, the standard level of income that your income's going to get you, right? So you can either, I suppose, you could, can upskill yourself. You can get more money in your standard job, either through long service or through upskilling or more responsibility or whatever it is. So you can do that. So you can get more income that way. I suppose if you've got time for it, you've got a bit ability to commit to it. You can do casual work on the side. You can resell things on platforms. eBay, Amazon, whatever, but all those things are going to take time. So it depends kind of what you're short of. And I suppose how much you want to put into those and how much you're interested in them as well. Because if you're really interested in your job, then maybe that's the best route to kind of increase your income. And if you imagine, we said, you're going to have 10,000 in the bank to get £500 back, or $500 or what have you back. Often, if you're getting a percentage increase, again, roughly in line with inflation, it's probably going to be worth more than that per year anyway. So almost working on earning more is probably going to have a bigger result than just saving. And then also you've got to think of things like, are you in a position which will probably be after you kind of have a bit of a safety buffer? Can you invest in other things? So and with the safety buffer, it's kind of like a rainy day fund or whatever, living expenses for 3 months, 6 months, what have you. You can do things like that. You can also, if you do already have a mortgage, you could look into, is it kind of better to pay off the mortgage, which, if that's 6%, rather than save at 5%? That might be something that you want to look into. And you can also, look into, I suppose, if you have either maxed out options like that, you can look at things like investments, which obviously, even with interest rates at 6%, it might still be good to invest. Also, it's not financial advice, but it's worth looking at kind of what returns are you going to get, and I suppose your income at the time, what have you. But also with interest on, on the general kind of performance of, for example, the S&P 500.